we're getting to a point of kind of, increased onshoring, increased, less cooperation, among nations, greater authoritarianism in general. And if you look at just innovation, America is still the place to be. The next Facebook, the next Google, the next whatever is going to come from America. And so that's a huge competitive advantage.
Brandon Ducharme is an investment advisor representative of and offers investment advisory services through SCF Investment Advisors Incorporated, an SEC registered investment advisor, 10150 Meanly Drive, first floor, San Diego, California, 92131, 800-955-2517, www.scfsecurities.com. SCF Investment Advisors Incorporated and Ducharme Wealth Management are separate entities. The information in this podcast is current at the time of recording. It is based upon sources and data believed to be accurate and reliable. The information, opinions, and forward-looking statements expressed herein are subject to change without notice. Moreover, all comments and opinions voiced herein are for informational and entertainment purposes only and are not intended to provide specific advice or recommendations and should not be interpreted as such. Further, the opinions expressed are Brandon Ducharme's and his guests and do not reflect the views and opinions of SCF Investment Advisors or any of its affiliates. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what is appropriate for you, consult your financial professional. This information is not intended to be a substitute for specific individualized tax or legal advice. Ducharme Wealth Management and SCF Investment Advisors do not provide legal or tax advice. These services are provided by separate entities. The guest speakers featured in this podcast are not affiliated with SCF Investment Advisors, nor are they affiliated with Ducharme Wealth Management unless otherwise indicated.
We talked about this because, I was this was about a year ago, I was kind of in this is the beginning of the end of dollar hegemony, blah, blah, blah. And he's like, yeah, but like, what's the next best alternative? It's not another currency. He's like, it could be gold. And, and the IMF is out there, kind of vocally for years now talking about, this idea of a global reserve currency backed by gold. I think they call it SDR, special drawing rights, which I think has some credence. But to your point, I agree. I don't think the dollar, it's going to be a very slow melting ice cube. It just structurally, it's going to become difficult for dollar hegemony to come unwound quickly. If nothing else, one smart thing Nixon did was kind of negotiate the, dollar denominated transactions of oil. And, you're starting to see, that kind of paved the way for, all commodities. And you're starting to see countries move away from that, most notably India and Russia, getting away from kind of the petrodollar transactions. But again, I think that'll take decades, not years to unfold. But in the meantime, I think the way that shows up in the markets is kind of this secular tailwind now for higher rates, which the Fed, to your point, is going to have to get in there and fiddle with markets in ways which are going to have unintended consequences, and B, higher prices for stores of value like gold and silver. I wouldn't be surprised if we start seeing, kind of a FOMO trade jump in, on the retail side for silver now all of a sudden, because it's kind of the more affordable cousin to gold. And, the boomers were the original kind of FOMO traders of these metals, back in the 70s and 80s. And, now the Gen Z and millennials is turning to crypto. But I think we're going to get back to seeing, people buying gold and silver bars or coins and putting them away in safes and things like that within their house. So it's an interesting time to be alive, as they say.
Yeah, I'm still always trying to wrap my head around the gold, like the gold backed dollar. I think one of the hardest things that I have a difficult time with when we talked about gold backed currency is that in order for that to happen, all the central governments would have to give up their control, right? Like any central government that goes to a gold backed currency loses their control to manipulate their currency. And quite frankly, even a digital currency with an open source ledger sort of does that as well, right?
Yeah.
Now, if you're in a dictatorship, that might not matter because you might just not give everyone access to the ledger, or you don't care what their opinion is. But I could see in the U.S. that being a really big issue if you can have members of Congress pulling up the open source code and for lack of a better term, blowing the whistle So I don't think like the central bank digital currency really replaces, or like the theories around that or concerns. I don't think that really replaces the dollar. I don't think gold, they can't do it because then you give up the control that you can use to manipulate it, right? And the political warfare that you can use with, managing exchange rates. So I don't, yeah, it's, it is going to be a very interesting world.
Yeah, exactly. Well, there's a couple of interesting things there. So, yeah, I mean, with trying to go back to the dollar, the gold reserve, it's funny, my mom has said this. She's like, oh, we just need to go back to a gold backed dollar. And I was like, that's impossible. It's like saying, it's, you move from, I used to work at American Express and you had, charge cards and credit cards. Charge cards can't revolve a balance. You have to pay it off every month. Credit cards, you revolve a balance. And there's still a lot of American Express cardholders that just own the charge cards. And so, as a country, we swapped from charge card to, credit card back when, Nixon, again, took us off the gold standard in the 70s, 71, on a Sunday night, no less, kind of surreptitiously. And, that was great because for the first several decades, we used that charge card intelligently. We used it to invest in, continue the analogy, build my small business, and et cetera. Now, the last couple of decades, America's used that charge card for, cruises and cars and, stuff that isn't positive ROI at the national GDP level. And so now it's, we've got a huge balance and the interest rate is high, but we can't pay it all off. We can't go back to a charge card. We can't go back to a gold standard. So yeah, you're 100% right there. It's like that cat's out of the bag and it's literally impossible to ever go back. So it'd have to be something new, like, and it'd have to be something multi-global, I think, like multi-country, like IMF special drawing rights. I'm not an advocate for that, but I'm just saying that theoretically, I think that has the best shot of, having enough credibility worldwide. I appreciate, the kind of, open, non-permission based open ledger, immutable, transfer of value, blah, blah, blah. The problem you get into immediately, everybody recognized this, including, the woman who runs the MIT task force that was working with the Fed on this is, well, obviously nothing the government, to your point, nothing the government does is going to be truly, immutable open source, code. And then with that, all it really is just a digital dollar. It's not, blockchain at all. And then you're just giving up massive privacy, concerns. And by the way, if you thought that was just theoretical, all you have to do is look at China, where they launched their CBDC in a massive airdrop back in 2021. And they've since used it with great effect to control people's spending, geofence their spending, restrict their spending to certain items on certain times of days, attach it to their social score, their social credit score. And so now I even think that people that might have been, pro central bank digital currency, 2 or 3 years ago are kind of looking at how it's played out. Granted, that's an authoritarian regime, sure, but politicians are politicians, and it's not too many jumps to see how that could massively start infringing on people's privacy rights here in the States. So I think now, again, to your point, I think that's an even tougher sell. I do think it makes sense for smaller countries, and El Salvador is kind of a good template for that. It's like, all right, we don't have credibility as a tiny, small, Latin American country, but if we fix our currency to crypto, now all of a sudden, we're attractive for international investors and, things like that, aside from whatever kind of, tax incentives they're offering. Just the credibility of that system in and of itself can kind of, get a small country up and running. I do anticipate we'll see more of that in African nations, if it's very appealing for them. Again, if all of a sudden you can flip a switch and say, all right, we're going to agree to play by these rules. Yes, we're boxing ourselves in terms of, what we can do down the road. But right now we need it, and that's going to attract foreign investment and blah, blah, blah. So yeah, no, it is interesting to see. In my mind, it's interesting to see, all right, what does the dollar slide look like? How prolonged is it? And what else emerges? Is it just kind of gold? Does a multinational gold-backed currency get traction? Maybe do CBDCs get traction, either in America or elsewhere? I don't know, but there's volatility in that kind of global reserve currency system right now. America is still the global reserve currency, but that's an increasingly kind of tenuous purge. And so,
but it's super valuable though, right? Like the US needs to have that global reserve currency status. And I think in the central bank thing. One of the things I always keep taking my mind back to is the people I have talked to. And well, look, when I was in the military, I was not a high speed operator. I don't have a super cool, history and background there, but I have friends that do, and I've talked to plenty of people that have, and sometimes it's as simple as, the guy that was the finance clerk, and you hear the stories about, the payoffs that they did during the wars in the Middle East of, millions of dollars in cash to different parties that the U.S. was essentially bribing, right? The U.S. government pays these bribes, and that happens all over the world. And if you got rid of cash and you got rid of that for a central bank digital currency, and you were the contraparty on those deals taken, you'll take the world's reserve currency. You don't want to take the house chips. It's like that gives up even some more control there. So the central bank digital currency thing, I don't want to get too hung up on that, but I think there's a lot of issues where that just doesn't really come to fruition, which does leave hard assets. And you're talking about internationally, that's going to manifest itself likely in metals, right? There's, seven precious metals. Right. So there's only seven compounds on the periodic table that, what is it? They can't corrode. You can't destroy them. You can hold them, right? Like you can't have oxygen couldn't be an element because it's like you can't contain it and transfer it the right way. So it's really 7 once you kind of X out all the parameters of what won't work. And it's gold, silver, platinum, palladium, iridium, maybe.
Yeah.
Maybe it's only 5. Yeah. Oh, and they don't decay. That's the other big part, right? Uranium, which we can talk about, the uranium prices, but,
well, yeah. It's, so I mean, back to that point about, what emerges. I mean, I don't see how it's not gold and silver. It's then, then the question becomes, all right, what does that look like? And, it could just be, like I said, I mean, I anticipate, even in our, even in some of our funds and accounts, we like the miners because, you've kind of got operationally got a leverage play on, whatever the underlying metal is, but also it's, you're starting to get a retail play. Some of these guys are starting to diversify into, wholesaling to, the JP bullions that you see on, late night television, that used to make fun of, your grandparents for buying the Golden Eagles coin. But again, I think that's, I think the retail crowd is going to start jumping in on that because, again, this, it's grocery prices going up like this, car insurance going up like this, inflation is nasty because it hits everybody right in the pocketbook. And for most people, it's globally, it's going to be gold and silver. And then the only question is like, all right, what, how do global central banks or governments try and, get their fingers into that pie, which, they'll figure out how to do, and who knows. But yeah, I mean, that's like I said, that's one reason where it's early on a year ago, we were getting bullish on gold, and it just said, listen, this feels like early innings because you've got this, there's going to be volatility along the way for sure, but this is just structurally setting up. There's a lot of big problems here on the horizon, that might not ever be catastrophic. You know what I mean? Like inflation, like, I tell people, I was having this debate with, an advisor, and he's like, oh, we're never going to go to hyperinflation. I was like, that's fine. I agree with you. We're not going to go to Weimar style, 1926 hyperinflation. We don't have to. But, even if inflation just kind of stays sticky, given that we printed so much money and that, the rate of change can come down, but it's, it has to be negative for us to get back to where we were. You know what I mean? It's like, it's going to take years for all this M2 to work its way through the system, especially when we're running fiscal deficits at the level that we are. And so, again, not to belabor the point, but it's hard to see how precious metals, commodities in general, but precious metals just don't have a massive structural tailwind here.
Well, I think that people forget, to your point, there's a difference between the rate of change of inflation and the rate of inflation. Right. So you can have inflation, people say, oh, inflation's come down, and they forget that that's like, it's more akin to, you're speeding down the highway at 90 miles an hour and, you see the cop and you try your best to slam on brakes without being too obvious. And, you slow it down to 65, 70 miles an hour. You wouldn't say, oh, I traveled backwards on the highway and I'm doing a redo.
Yeah.
You would say,
exactly.
hey, my speed came down, right? Like that's exactly what it is, but you're still barreling down the highway in a, 5,000 pound vehicle at 70 miles an hour. And if you really want to take that back down to, if the speed limit's 25 and that's a sustainable, safe speed, it takes a bit of effort to slow it all the way down to that level. And what the Fed's trying to do is obviously get there without slamming on the brakes. But if the safe speed is 25 miles an hour, right? Most people would still agree it's pretty dangerous to drive 40 to 50 miles an hour.
Yeah, exactly. That's actually a great analogy. I'm going to reuse that, but I'll give you credit.
Yeah, thanks.
But that is the analogy. I mean, that's exactly it. Is exactly. Everybody was used to, living in a neighborhood with 20 mile an hour stop signs, and now all of a sudden it's like, whoa, we're shot up to 100. All of a sudden we're on the Autobahn. Everyone's like, what the heck is going on? And yeah, it's coming back down, but it's still way ahead of what people were thinking.
Well, yeah, think about that. If the Fed target is 2% and 2.5% is viewed as generally sustainable, I mean, and that has its own ethical and moral debate to it, right? But generally 2.5, anything under 3 would be considered sustainable. So if your speed limit's 25 and all of a sudden you have people going through your neighborhood or whatever, at 90 miles an hour, right? That's the 9% inflation print we had. You're going, someone's going to die.
Yeah.
Right. And you want that to come back down, but you got to start putting law enforcement out there and all these efforts to try to get the traffic speeds down, especially when structurally everyone says, I thought this was like a 55 now. Right.
Yeah, exactly.
You're going, no, it's a 25 still. And I was like, what? Everyone goes, I'm just going with traffic and it's going 55, 60 miles an hour. You have to slow it down, but to slow it down is a huge effort. And then people get really upset about that too, because it has its own unintended consequences, right? Because now it's sort of baked into the system. So everyone's saying, well, I thought my commute to work was only, X minutes. And now you're telling me it's going to take so much longer because you've brought the speed limits down. Well, no, we brought it back to where it was sustainable and safe. And you were speeding the whole time. But if you look at...
Yeah, and I think that's the fiscal deficit spending too, which is kind of countering the Fed. I wondered, how irritated must the Fed be that you've got all this fiscal stimulus in it. I have to credit, I think it was James Bianco that said, we've never had fiscal stimulus in America above 6% when the unemployment rate is below 4%. That's usually reserved for dire circumstances like, 2008 when the unemployment rate was, orders of magnitude higher than it is now. And so, the fiscal stimulus is hugely inflationary. And, we're at a point where irrespective of political party, I think it's here to stay. Maybe one party is a little bit more or less than the other, but politicians in general have just, the whole system, that's a whole separate topic for a different day, but the whole U.S. political system has now just been, and you see with the insider trading and all that, but there's just too much kind of fat in these bills. And again, it doesn't matter who wins. It's both bills are going to be stuffed with, tons of spending that the taxpayers are paying for, and it's all going to be inflationary.
Yeah. I think my favorite Jim Bianco quote ever is he got up and started by saying, I was going to design. Okay. And I'll preface, I'm not going to mention the ticker that he mentions, but for your own edification, it's a 3-letter ticker that has to do with long-dated bonds. He gets up and says, I was thinking of designing this machine or apparatus that its sole purpose would be to incinerate money. And so you just put money in and it just destroys it and it's gone. And he said, but I figured I don't need to because such and such ticker already exists, And he was talking about how like billions of dollars had flowed into this fund, and the net asset value, even adjusting for the yields it had produced, was just the money was gone basically, right? Because all the bonds within it had been repriced and just kept repricing lower and lower and lower as the Fed deals with the struggles on the long end of the yield curve. Jim's a funny guy he's got some interesting takes and he's got a good way of explaining them too. That's captivating.
Yeah. One thing he said too, which, candidly, I hadn't really thought about, but this was a couple of months ago, back when the market was still kind of pricing in, multiple rate cuts, starting in the summertime. And, for me, kind of, fundamentally from the economic perspective, that just didn't seem likely. I was at that point, I was convinced that inflation was going to be sticky. Something was going to rear its ugly head, whether it was oil prices or whatever. But he made the point, which now I think is very valid and credible, which is, there's a political element here. Obviously, it's an election cycle year. And this is a quote of his, he goes, I don't think the Fed, he goes, the Fed is political, but they're not partisan. And he goes, what I mean by that is they don't want a particular guy to win, or at least not ostensibly. I mean, everybody has their own candidate or whatever, but, the Fed as an entity, doesn't want to see, one person in the White House over another, but they are political in the sense that they recognize they're going to be painted either way if they, do anything prior to the election. And so I think that's interesting because I agree with that. I mean, from what I've read of Powell, gauged from Powell, he doesn't want to be blamed by either side for doing anything ahead of the election. So I think that, you've started now kind of recently seeing, or at least I have in the last couple of days, talks about, all right, maybe the market's increasing the odds for 2 rate cuts starting in September. And I'm like, I still think they're going to sit on their hands until after the election, and then even, potentially depending on how quickly the data turns.
Yeah.
Maybe 1 cut this year.
Yeah. Jay doesn't want to get blamed by either side. And so in effect, he's probably going to get blamed by both sides no matter what.
Yeah, exactly.
That's probably what's going to happen. So, what's, I don't know, what's the play here? I always think inflation and all these issues, you can try to be a short-term trader and, be a macro investor and you can, I mean, there's some great money to be made. There's some, good money to be lost if you get it wrong. But if you zoom out a little bit further, right, and so you take out kind of the intra-time period volatility and noise, we had all this inflation, but over the same time period, right, the S&P 500 is as an index is at an all-time high. NASDAQ 100 pretty close right now. Gold's at all-time highs, which, by the way, people forget gold is a risk asset, right? If you look at sort of, its underlying correlations, right? It's a risk asset. But people will say, well, the dollar's getting destroyed. So the Fed's got to raise rates and all this stuff, and it should be, collapsing down the market. My thought and theory is everyone always checks their statements in like whether it's their 401k or their brokerage accounts or whatever, they check it. They don't open it and say, do I have the same number of shares? What do? They check it and say, what's it worth, right? How much money do I have? How much money do I have in my IRA? How much money do I have in my brokerage account? And they forget that they have assets in their brokerage account and they're seeing what their assets are worth right now. They're seeing a liquidated estimate. And I guess, so then you have to, I'm trying to bring this full circle to what are the assets that are then going to do okay through an inflationary cycle, remembering that there is a difference between what you own and how it's priced in dollars.
Yeah.
Right. And here's my thought is there's, going kind of a step further, you have hard assets and you have, people call them paper assets, right? And they get somewhat convoluted. So if we think about like gold, if I have a gold coin in my hand, it's a hard asset, right? You can't really destroy a gold coin. Now I have some risks that somebody could steal it. I could lose it, whatever. It has some of its own risks there. But people will say, well, gold goes up over time, and gold's always going to be worth something. Okay. Well, I feel pretty confident that if I zoom out on a chart of the S&P 500, I could say something very similar about the S&P 500, right? Like given enough time, it kind of goes lower left to upper right. we both know that doesn't mean that it's, some sure bet. You just, put money in the S&P 500 and start making money. That's not how it works at all. But how much different is a gold coin versus a share of, say, like just as an example, McDonald's, who a large part of their business model is owning commercial real estate land. And so you own the paper asset of, share McDonald's, but that asset owns land. So you have, it's a hard asset or a soft asset, but they're all assets. They just get repriced in dollars. So then it's a figuration of volatility and, market beta. What are you looking for? And so then what's the play, right?
Yeah. No, I mean, I think it's interesting from the context of kind of like, portfolio allocation. So, you look at equities, and I agree. I mean, it's kind of like the old Warren Buffett quote, which is like, betting against equities at any point in America's history has been the wrong bet. And I don't think that's going to change. I mean, in particular, because, you look globally, I think we are going to a point, we're getting to a point of kind of, increased onshoring, increased, less cooperation, among nations, greater authoritarianism in general. And if you look at just innovation, America is still the place to be. The next Facebook, the next Google, the next whatever is going to come from America. And so that's a huge competitive advantage. Also, our demographics aren't great, but they're certainly not as bad as really anywhere else in the kind of, developed world. Obviously, Africa is the best, but, you look at, China, India's got good demographics, but, China's are poor. So, like I said, America's, aren't great, but they're not bad. So between that, that's enough of the raw materials, I think, to keep the American engine going. And you look at the S&P as an example, or the NASDAQ or whatever, those are dynamic. I always like the charts where it's like the top 10 companies in the S&P, year by year, starting in 1999 during the dot-com bubble. And, there's a couple of familiar names, but there's a bunch that drop out. So, it rotates over time. I think what's interesting, and maybe with, so then the question becomes, all right, well, can I set it and forget it? Do I maybe start to rotate more into active management? I do think we're going to say, I do think the active to passive migration that we've seen since 2008 is going to start to move the other way now. And that brings me to my next point, which is particularly within fixed income. I think the big move we're going to see, and this is we're seeing this emulated in all the conversations we have, both institutionally as well as with advisors, is all of a sudden, people they're less concerned about their equity books. It's more maybe tweaks at the corner, to reflect a certain view or something like that. All of a sudden, it's like, all right, my huge ag position that I had, I've got to go revisit that and divvy that up across 5 active managers, or I've got to do it myself and have a view on, where in the fixed income ecosystem I want to be. People, it's interesting. I've started seeing all these articles now. We wrote one of these articles about, what is exactly the Barclays aggregate U.S. bond index. Let's look under the hood there. And that's an index from the 80s. And, it hasn't really kept up with the innovations and the kind of breadth of the fixed income ecosystem. There's a large part of the fixed income, environment that just is completely left untouched by the ag. And, super compelling parts like high yield bonds, bank loans, non-agency mortgages. And the ETF landscape has been a very democratizing force. It's gotten very sophisticated. Let's not forget, up until really, 10 years ago, the, ETFs were pretty plain vanilla. You had kind of factor, most of it was equity and, some fixed income. But, fast forward now, there's ETFs for all kinds of interesting nuanced exposures, in every asset class. Uranium is a perfect example. And so that empowers now investors and advisors to go out there and do a lot more. I mean, it really encroaches, frankly, on kind of the professional hedge fund landscape. And so I think we're going to start to see that on the fixed income side for sure. I think we'll also see. You'll have to correct me if I'm wrong, but I think one of the largest, if not the fastest growing segment of ETFs this year or last year has been actively managed fixed income ETFs. And then I think we'll see the same thing on the commodity side. I think you'll see a return to capital inflows into commodities funds, managed futures funds. Because, during a zero interest rate environment, commodities looked horrible. They had a big drawdown. They weren't doing anything. They were a source of, return-free risk, as the saying goes. And now all of a sudden it's turned the other direction, and it's got a low correlation, which, to put a pin in this thought, I think now investors and retail alike are starting to appreciate. That was one of those things that just, was kind of a theoretical abstract, so like 50% drawdowns. We always tell people, especially anybody considering crypto, remember, this is an asset class where, you're going to spend a lot of your time in a 50% drawdown, which mathematically means you have to double your money to get back to break even. So that's an asymmetric, that's an, increasing, that's an exponential increase in, negative outcomes, as you go down the drawdown curve. Same thing with correlations. Correlations didn't, nobody cared until 2022 when equities and bonds were, both down big that year. And so now all of a sudden people are looking at alternative asset classes, mainly things like real estate and commodities, and saying, all right, now all of a sudden they have a forward-looking positive expected return premia, also one that's structurally, has a lower correlation to these other asset classes. This looks interesting. So I think, to answer your question, I think that's where we're going to see a lot of the activity is, fixed income, and then kind of alts, more specifically real estate and commodities.
Yeah, I think that's super valid. I think the interest rate environment has led to some good news and bad news for asset allocators and financial advisors out there. The good news is that the bond market is kind of the easiest to allocate to and trade, right? If you need to build a custom portfolio for clients to meet their specific needs, right? The bad news is that most of these advisors haven't done anything to sharpen that skill in the last 18 years because they haven't needed to. They could toss it in the egg. They could toss it in one of these index, bond funds and let it ride. And the issue that I've seen is that they would explain to people, well, bonds are your crash. This is your crash protection, right? This is when stocks go down, this is your ballast, to your portfolio. This is what's going to keep you alive. This is, if you need money, this is where we're going to get it from. And we can go through that, for years and before we'd need to sell your equities, right? Because everyone was worried about a stock market crash like '08, and no one was worried about a bond market crash because who worries about bonds, right? It's like the boring part of your portfolio. So they go allocate. But if you look at how low interest rates were for the last 18 years, who would have been okay with seeing your statement and, 20% of your portfolio is in a money market account making 0.1%. You'd have been you would have fired your guy so fast, it wouldn't be even funny. And if you just said, well, hey, listen, that's we're looking at duration risk and that's the duration profile we're happy with, and you would say, get me out of bonds or something, people would be like, it's not okay with me. So the advisors would just put them in a blended index fund like the egg and say, well, this is what the egg's kind of doing right now. And then we both know that the duration risk under the hood on the egg had creeped up significantly. And so now all these advisors had told people, well, we have this low cost index fund. It's the index is the index. And this is the risk of your portfolio. And they're looking at, back tested, or historical performance of that index. Meanwhile, the duration or the risk profile is creeping up, and that hadn't really been tested or doesn't have any historical data to look at, and so people's portfolios start, the stock market goes down and then your crash protection's going down, and that's a scenario disaster. But most advisors don't know how to handle that, or they haven't done anything to sharpen their skills around, well, how do I get allocated to the right bonds and manage that appropriately? Or how do I even simpler than that, how do I interview active managers to make sure that I get allocated to the right ETF or mutual fund that is an active bond manager, right?
Exactly.
They don't even know how to do that.
No, I think that's a great point you made at the beginning, which is, a lot of investors across the spectrum, advisors all the way up to institutional, just really haven't sharpened the fixed income, tool set. And so now all of a sudden it's like, all right, and we've had this conversation a lot where it's like, all right, let's remember, it's not just credit risk with bonds. You've got duration risk, and that reared its ugly head. Credit risk is there too, but you've got duration risk, and then theoretically you've got kind of reinvestment risk. If you look at the T-bill and chill trade, it's like, all right, I can't knock that. That's great to get 5%, but
it's great for now.
It's great for now, and also we had one of our dynamic fixed income models last year if people, a lot of people complaining saying, oh, it shouldn't be in bank loans and high yield, credit dividend is coming. And I said, look, credit dividend is coming. No, anybody that reads the headlines and sees, these landlords turning over, these huge apartment and office buildings in downtown San Francisco knows the credit dividend is coming. But it might not come for a year or two, right? I mean, we've got, a lot of mechanisms structurally that can kick that can down the road. And in the meantime, high yield bonds or bank loans or things like that, yes, yields are tight. Again, I know structurally and fundamentally all the things that are pointing to an eventual credit event, but that eventuality might take 6, 12, 18 months to play out. And in the meantime, there's 300 basis points of additional premium there to harvest. Now, again, to your other point too, well, all right, you've got to keep your finger on the trigger if you want to, engage in that trade. Yes, I agree. I wouldn't advocate for that as kind of a set it and forget it, position. But again, that's the kind of thing to your final point of, conversations you would want to have with an active manager, which is like, all right, let me help understand what is the nature of the strategy, including, what is it investing in, what is the rule set, what is the expected risk parameters, and then does that dovetail with my, view of the world and other strategies I have in my portfolio for whatever the asset class is.
Yeah.
But yeah, fixed income, I think fixed income is going to be a really interesting one. So yeah, I think it's going to be I think it's ultimately going to be very good for advisors because you're going to see them bifurcate into those that are sophisticated and have views and, have kind of thoughtful approaches to help navigate this world. And then those that, frankly are, glorified annuity salesmen and, tides going out and you're going to see who's swimming naked, to paraphrase Buffett.
Yeah. I'll give some free advice, or not advice, but knowledge, I suppose, I know there's other advisors that listen to my podcast and, whatever. So if somebody's going to talk to, look at a bond fund, right, and you're constructing a portfolio, one of the things you want to make sure that you do is look at what's your equities portfolio doing, right? Your equity positioning. And then what's the correlation of that bond strategy to your portfolio? Now you can allocate there and essentially get one fund. Most people will find that doesn't still fit all the parameters, right? Like if you find a fund that they're more of a risk on fund or strategy that's going to try to pick up long duration, right? Tactical in nature, maybe you want to look for something that, still has a low correlation to that. So if you want to layer on like a second bond fund, you want to look for a correlation that is low correlated or lowly negative correlation. So you're looking for like negative 0.2 to plus 2.2, to the first bond fund, but also have a low correlation to your equity sleeve. Otherwise, what you're doing is you're adding more risk in the same way that you're adding risk in the equity sleeve, or you're having two managers doing the same thing.
Exactly.
If you have two managers doing the same thing, pick the better manager that has the better correlations to the rest of your concepts and ideas, and run with it.
Exactly.
One of my new favorite terms I heard out of the other Ben at IDX a couple weeks ago was he just calls it worsification. Right? You just put more ideas in a portfolio just to have more ideas. It's worsification. So
yeah, exactly. No, and I mean, I think what's interesting and good for advisors, though, again, specifically as it relates to the fixed income landscape, is in this. There's a lot of research articles that have borne this out, but the opportunity for increased marginal benefit of diversification is just higher within that asset class, and there's a lot of reasons for that, including just kind of the heterogeneity of the landscape. Bonds themselves, if you look at the different ecosystems, are structurally have lower correlation than like equities, for example, where there's periods where all the spider sectors are very highly correlated, and so there's a lot more opportunity for active managers to then, on top of that, however they apply their particular trade to further increase the differential among correlations. So I think that's a really good kind of opportunity that's kind of a low-hanging fruit for investors to improve their portfolios, is just simply, like you said, find just two active bond managers that are doing structurally different things, and both have, positive expected return when, whatever they're doing. And that's has the opportunity to, I think, move the needle the biggest in most portfolios. And then the second one would be, allocate more to alternatives, things like real estate, not crazy, just, real estate, commodities, again, probably active in nature, and just get away from, we have an opportunity now, and that there's, positive expected sources of return that aren't just, long duration US bonds and equities. Even honestly, emerging markets debt, I think is going to start to get interesting here. EM countries in general, there's going to be some kind of neglected sectors that all of a sudden are going to start looking potentially interesting over here in the next couple of years.
Well, look at the ripping ride utilities have gone on the last several weeks.
Yeah.
I was like, that was my grandpa. My grandpa's play was utility companies. He's like, boring old utility companies, and his like, grandpa, what's your investment thesis there? He's like, someone that's going to stop using electricity. Like that's his thesis. That's his, and he was a great investor, great trader. And, in hindsight, right, you could always do better, but, grandpa did a nice job. And, but it was like the boring, it's like, who wants to own the electric company or this or that? And all of a sudden utilities are up. Utilities were ripping, and then all of a sudden you find out it's like, well, it's this AI play.
Exactly. Yeah. So grandpa's advice, it's kind of like the old, Warren Buffett. It's like the boring old industry all of a sudden turns around and is super relevant again. And it's because it's the same thing with copper, right? I mean, it's like all of a sudden these are like AI adjacent uranium too. These are kind of AI adjacent, clean energy adjacent plays, and it's the picks and shovels layer of AI. NVIDIA's already ripped. Obvious names have already priced in this, new industrial revolution, presumably, but now it's, the utilities, the copper, all that. So it's, slow and steady wins the race.
But those can also be extremely volatile sectors, right? Like commodities and utilities can be very volatile.
Oh, for sure. Yeah. I remember having a conversation with a bunch of advisors in the Midwest early in the rate hiking cycle, and utilities are getting crushed. One of the guys was like, "What the hell's going on here?" And I was like, "Well, think about it. These are basically bond proxies. Like they're sensitive to interest rates, so that's they're repricing. And you've got this other effect where it's kind of large cap tech has kind of emerged as kind of a new quality play. And so that was the dynamic you saw kind of playing out. And and to your point too, I mean, commodities of course are definitely extremely volatile. So that's another one where it's like, all right, yes, there's a long-term kind of structural thesis for copper, for a lot of interest. Let's just, pick that one out of a hat, for a lot of interesting reasons.
Well, that's everyone says they're a high-risk investor until they experience volatility.
Yeah. It reminds me of the old Mike Tyson quote where it's like, everybody's got a plan until they get punched in the face.
It's 100% exactly it. I try to help people understand that. And I'm like, because I had a situation recently where, I had to do some coaching with a client. They said like, well, I don't want to be bound by, a risk assessment we did 6 months ago, right? Like I could feel different today. And I'm like, that's the whole point of why we did the assessment, right?
Yeah, exactly.
It's like, that's exactly the reason why. And yes, you're in the driver's seat, and yes, I'll do whatever you want. And yes, you can make the final decisions. I'm just here to be an advisor. It's like, but you're going to also feel different on the day when you lose 15, 20, 30%, right? It's, we got to have some kind of, baseline a conversation to point back to here. Volatility wrecks people. So, commodities are super volatile, right? People know that, and people that have experience around trading commodities know that prices can be very volatile, right? I remember I put on a trade, and I wouldn't recommend anyone do this, but it was around the time that there was the big snowstorm in Texas a couple years ago. And I put on a nice trade, in a commodity and it had some leverage exposure, and I made some good money on it. Had I stayed in that trade about another 3 days, I would have not only made no money, I would have lost a ton of money. Right. Yeah. So that's in my own personal, stuff. This is several years back. And in hindsight, it was luck. I had no clue what I was really really doing on that. But the prices can move quick, right? And so there's intraday volatility though, but then there's your kind of your midterm trend. But most people would say, well, I don't want commodities in my portfolio because when I go look at the benchmark, right, you go throw an index, commodity index into your portfolio. And it's like you said, it's like, wow, hey, this has been a real great, return, how'd you say it?
Return-free risk.
Yeah, return-free risk added to the portfolio over the last, 15, 20 years because we were in the cycle of deflation, and not really deflation, but a period with no inflation, right? So you're just taking risk and you're not, without inflation, commodity prices really don't do a whole lot. But one of the unique things about commodities sort of as an alternative, an idea or asset class is that if you trade it the right way, right, even in years where there's kind of nothing going on, right, there is no inflation, there is no, major events, there is still some events that can drive prices of commodities in different directions. If, just think, bad winters or, heavy rains can affect a crop, or fires or something. So there's stuff that can drive prices even when the stock market might be up, the stock market might be down, everything might be quiet, whatever. Commodities, totally different alternative idea, but you kind of need to trade it is my thought. What's your...
Yeah, no, I agree with you. Commodities is one asset class where, you almost categorically, you want to be very mindful of kind of a grab it off the shelf, static benchmark ETF or something like that. For two reasons. One is exactly what you just described. Well, first of all, I mean, a lot of them, again, just to take the benchmark static index, not any one in particular, but, that idea of which there's several, with commodities, you have to express those trades generally in futures contracts. And, futures contracts are, priced at multiple different points in the future. And we all know why they exist. It's for end users to, hedge future crops. That means that there's a term structure. We all know, whether it's typically in contango, could be in backwardation, but generally it's in contango because there's storage costs, things like that get priced out into the curve. And what that means is if you just buy, DJP or whatever off the shelf, there's a roll cost there to just simply holding that exposure. It's not like buying a stock and, all right, I've got 10 shares of IBM or whatever. And I'm, that means, my pro rata percentage ownership in this company is what it is. I don't have to keep paying to maintain that. With commodities, you do. And that's meaningful. I did an analysis years ago of USO, the oil ETF relative to commodities futures, and just showed what that roll tax, as they call it, is. In a year like 2015, I mean, it can be double digits. So it's meaningful. And so there's, back to the point about, the Barclays Ag Index or something like that, you want to understand what the index is that you're investing in and how to mitigate some of these low-hanging fruits. So with commodities, you can start, what they call roll optimized exposures. And there's tons of groups that, that have kind of roll optimized exposures. I used to work at Van Eck has one. That's a way to remove a lot of the headache, a lot of the cost of, just simply, maintaining that commodities exposure. Now, on top of that, you've also got, all right, well, how do you know which commodities you want to own? Again, if you look at a lot of these indices, they're just weighted by open interest. That's kind of like, that's my joke with like the Dow. It's like, well, the Dow is weighted by price. All right, well, price doesn't mean anything. 100 years ago, the price of a stock was a proxy for quality because, they weren't as creative or as aggressive with engineering share splits and things like that. But now, it's the market cap, yes, conveys a measure of quality, but price is almost irrelevant. So it's a horrible way to weight an index, but it's here for legacy reasons. Open interest, same thing. That doesn't necessarily reflect, why you'd want to own a lot of one commodity, versus another. And so, then there's indices that, might hold equal weight commodities in a roll optimized fashion, or go one more level. And it's like, well, there's active managers that will, tactically allocate or adjust commodities long or flat or short, depending on the environment, like trends. And also will incorporate all the roll optimization and things like that. So commodities like fixed income is one where a little bit of innovation and active management can go a long way towards improving the expected returns on a go-forward basis, or at least the expected risk return profile, I should say.
Yeah, I think it's a really unique space because of the non-correlation. I just think you have to figure out how to do it in a risk-adjusted manner, so that way you're not adding, all risk, no reward, or all risk, little reward. You want to try to always flip that back to, an asymmetric trade in your favor whenever possible, right?
Exactly. You want to manufacture a cheap call option as cheap as you possibly can. And look, momentum, we've written research papers on this. A lot of other people have too. AQR is probably the most prominent. Trend following, one of the reasons it's endured as a methodology, and the managed futures guys, as well as us, like to employ it, particularly in asset classes like commodities, is because you've got a lot of disparate assets, that are structurally uncorrelated. The wheat markets are not going to have, anything to do with, gold, other than, general macro trends like interest rates and, things like that. But those are, and, you've got dozens of different markets like that. And, that's a lot of raw material with which, if you can, manufacture an expected payoff profile using momentum as an example, you can start collecting a basket of, cheap call options where, again, we've demonstrated this from a research perspective, can actually be cheaper than the outright cost of buying an option. So that's what, to your point, that's what you're trying to do really with any asset class is, get that asymmetric payoff profile without having to pay to the nose to get it in the options markets, which have gotten very expensive.
Yeah. Well, implied volatility drives those prices up pretty quick.
Yeah, exactly. And it's durable too. The IVs have kind of structurally gone up kind of across the board on both sides, puts and calls. And it's, if anything, I think that's why you've seen a lot of these kind of put right funds come to market, is because it's selling that insurance in a, fully collateralized covered way is kind of one of the last free lunches out there, in addition to, diversification.
Yeah. And it's a whole nother conversation for another day, but I always wonder how much, the retail involvement has led to that increased kind of, stickiness in the implied volatilities in the pricings of that stuff and how it works. I don't want to get too specific because then I'll have to cut a bunch of stuff out of this podcast.
Yeah.
But, anyways, I do think about the effects that the retail traders and entering the marketplace in the last 4 or 5 years has really had on some of these major changes.
Well, even, look at like two things, right? And, GameStop. GameStop was just a bizarrely fascinating phenomenon for me, because when that first started happening, I was like, oh, this is interesting. It's funny. We had just finished doing a big joint collaboration with Johns Hopkins Department of Natural Science or Natural Languages, where we built an NLP model. This is pre-ChatGPT, so this is like 2018 or 19. But what was interesting was, so we had this whole apparatus, and the GameStop thing started emerging. And so we went to the Wall Street Bets channel, and we're like, all right, we'll scrape this channel and let's categorize it for, all this interesting, see what we can emerge. Basically, the analysis was not usable because literally, I think 17 of the 20 words that came up in our relevant heat map were not fit for, radio or TV. So I was like, oh, this is entertaining, but this is just all gibberish. Yet, they put a huge hedge fund out of business. They're driving, and I'm like, wow, this is kind of, this is similar to like Dogecoin or something, these kind of meme coins, which I was quick to write off, but they've endured. They're still here. And, I can only chalk it up to, we've just kind of entered into this kind of new world order of, quote unquote, or rather, investing overlapping with kind of speculation, not even speculation, but people just like starting to fly these kind of cultural flags that just happen to be in the form of putting, dollars behind something.
Yeah. Well, it's all interesting stuff to think about, and it'll be interesting to see where we land, next year, and the year after, and the year after that. Time will march on, and we'll probably all still be here. I think Kiyosaki's wrong. The sky is not actually falling. The weather may be changing, but the sky's not falling.
But he gets a lot of clicks. That's the one thing that'll always. I see it always pop up on my Yahoo feed. I'm like, oh, here we go. It's but it gets a lot of clicks. So
yeah, he doesn't. Well, he's not in the investment advice business. He's in the media business.
Yeah.
So
exactly.
Yeah, so be it. Well, anything else you care to share before we wrap up? Any good jokes? Any good market sentiment ideas? Any good? You want to make you want to do a forecast and we just pin you to the wall next time over it?
No, I mean, I think what's interesting for us, we're keeping a close eye on the consumer. We were in the camp where, we're kind of looking under the hood, for the last couple of quarters. And, there's always been kind of an asterisk behind the numbers. It's like, yeah, the job numbers look great, but we're getting a lot of downward revisions. You're getting a lot of people working, 2 jobs, which, shows up in the BLS numbers, but, not necessarily the household survey. Again, as I said, I started my career at American Express. I'm always looking at, consumer credit numbers, and you're seeing defaults start to, very weirdly tick up pretty aggressively. Walmart on their last earnings call talked about, they've done well in part because the more affluent customers are starting to, shop down, quote unquote. Reminds me of 2008 when, there was a metric about how many Jags and Mercedes are being counted in Walmart parking lots. So, I think that's the shoe that everyone's kind of been waiting for to drop. And, the data's starting to get soft. So that's something to keep an eye on. Obviously in conjunction with inflation, which everybody's watching, but I think it's the consumer. I think, the almighty U.S. consumer, which has kind of powered this economy in large part due to excess savings from COVID and, fiscal stimulus, when that starts to slow down, and there's, charge-offs can only go so high before, spending retracts. I think that's the canary in the coal mine to look at. So, for those out there that are, looking to, maybe be a little bit more tactical in their portfolios, like I said, that's the canary in the coal mine that we're pretty focused on.
Well, we'll have to circle back in a couple of quarters and see where we're at. It's all that stuff takes time to develop and work its way through until it doesn't, and it happens. Exactly. So, anyways, well, hey, I appreciate your time. It's been fun. It's been a fun conversation.
Always a pleasure.
So
until next time.
References to securities indices such as but not limited to the S&P 500, Dow Jones Industrial Average, NASDAQ Composite, MSCI, EAFE, and Russell 2000 reference an unmanaged group of securities considered to be representative of segments of the stock market or overall stock market. These indices may be market weighted with the largest companies in the index representing a disproportional percentage of the index. Investors cannot directly invest in an index. Investing in real estate and securitized real estate may not be suitable for all investors and may involve special risks such as limited liquidity and demand for real property. Changes in supply and demand for real property, change in law, tenant turnover or defaults, loss of investment, competition, casualty losses, use of leverage. Real estate values may fluctuate based on economic, environmental, and other factors. There is no assurance that the investment objectives of any real estate program will be attained. Any hypothetical example contained in this document are for illustrative purposes only. They do not represent the past or future portfolio composition or performance of any specific investment and are not intended as investment advice. We suggest working with your financial professional to see which allocation opportunities may be right for you. The return and principal value of stock prices will fluctuate as market conditions change, and shares, when sold, may be worth more or less than the original cost. Asset allocation and diversification are approaches to help manage investment risk. Asset allocation and diversification do not guarantee against investment loss. Past performance does not guarantee future results.